All right. Hello, everyone, and welcome to our Composer webinar on how active traders build structure and process for consistency. I'm Michael, a product marketing manager here at Composer, and we're excited to have Ron with us, founder of Trading Dominion. Ron has a plethora of experience in trading and has coached thousands of traders. Welcome, Ron.
Thanks for having me. It's great to be on with you guys. We've actually been fairly heavy users of composers for a while now.
Awesome. Yeah, Ron, it's great to have you here.
Just to give everybody a bit of a level set in terms of my intention for today is we have covered the list of questions that were submitted prior to the webinar. I've taken those kinds of questions and incorporated that in through to the slide content that we'll be walking through today. So hopefully I can address that as we go through. But in particular, I really like to focus on trying to give everybody practical takeaways from a webinar that they attend. So hopefully there's plenty of little gold nuggets throughout the presentation here that we can go through today. So very quick recap. I was basically born in Argentina, which is South America, southern tip, more or less, for those of you that don't know that. I then moved through to Australia when I was about 5. Pretty much grew up over there. Graduated from university as a programmer, basically, so computer science and information technology. After that, went directly in through to doing a postgrad dip in Diploma of Education, basically where you learn to teach. And then after that, I started teaching computing and maths in a college over in Australia. So that was pretty much the time that I also started to trade, which was basically around 1995, somewhere around there. But professionally anyway, in terms of the normal day job, I then switched over through to systems engineering a couple of years after the teaching out of college. So systems engineering, for those that don't know, is it's not programming, but it's basically looking after primarily networks. So I kind of specialized in a whole pile of different fields of systems. So everything from networking through to firewalls, security, databases, email systems, storage, cloud, you name it. Well, cloud came years later, but eventually was that too. So that was systems, and I basically did that for quite a long time, basically 20 years, I'd say, all up. But I did it for 10 years in Australia, then moved through to the US in 2007, just prior through the financial crash. And then 10 years after that, founded Trading Dominion. When I was working here in the US, it was actually tricky because I was literally flying every single week to anywhere around the USA because I was consulting for large companies doing systems. So that was a real pain. So that was one of the reasons that I wanted to, find a way to snap out of having to do that kind of work, just being away from the family pretty much all day, every day. I'd fly out Sunday night and come back, Friday night kind of thing. So I'd only spend about a day and a half at home, which was a bit rough. Also, obviously, rough on the wife because we've got 3 kids. So that was pretty tough on her too. So anyway, so I did that for 10 years. And then after that, during that process, I ended up starting to build up my community privately, I guess, just through private Skype groups at the time and various other things. And then founded Trading Dominion. Now, I mentioned that I started my trading kind of life, if you like, on the side back in the late 90s. And I tried to get AI to kind of mimic what my room used to look like. It used to look something like this without exaggeration. So I literally had, I don't know if you guys were trading back then, but I started off with a company called a system called the Pristine Method with Oliver Velez and Greg Capra. I think Greg is still around. I think Oliver may have passed away though, but they had, basic TA systems, and I went through a whole bunch of their content, and I'd literally have all of my walls pasted with setups exactly like this kind of thing, like every single wall. I looked like a complete psycho. Later on, I started getting into day trading, and my one monitor grew to 4. I was on the borderline of trying to go to 6, but I thought, no, 4 will do. And that was interesting, that kind of process. I think a lot of people that do start trading go through that kind of evolution that they well, as a matter of fact, this is part of the next slide here, right? In terms of what are the expectations that you actually have, and we all kind of go online and we're sold on this dream that you know buy my guru course and within 2 months you can quit your job and trade from the beach while someone gives you a nice back rub and you sip on a cocktail, right? Travel anywhere in the world, from anywhere, complete freedom, blah blah blah. So I guess like everybody else, I kind of fell for that, and I was chasing this particular dream, and I chased it for 20 years. It was a lot of ups and downs, a lot of downs, a lot of chasing gurus, chasing signal systems, chasing black boxes, lost plenty of money doing that kind of stuff, and eventually got to a point where I kind of said, you know what, this just doesn't work for me, and I need to get to the point where I can fully understand for myself exactly how these trading systems work and not be reliant on anybody. But of course, that takes a long time to actually learn. Now, I'm just kind of curious. Let's see if we can do a little bit of interaction here. Would people mind typing in the chat? What is your expectation of what you believe you'll be able to do in terms of returns on your entire account? Let's just keep it to per year, just to pick kind of something, because I'm interested to see what your personal expectations are, and then see if we can have some kind of common ground. All right, starting to see some people saying 20, some saying 40, 25. I'll give it another couple of seconds. Okay, all right, so we seem to be somewhere in that range, which is interesting. I know for sure that, in looking at, again, trying to rewind and go back through to expectations that I came across many times when I would, study under various gurus, you regularly had things that were much, much larger than that too. I remember there was even one that I studied under claiming something insane as 2% per day. Just to give you an idea, it's like, no. So just to try and level set here in terms of what I think I believe is something reasonable. If we look at one of the world's all-time best traders and investors, Warren Buffett, who just recently announced his retirement, you can see that from 1965, his company, Berkshire Hathaway, had a compound annual growth rate of basically around 20% per year through to 2023, which is amazing, okay? But the thing to think about is that this is an example that's considered kind of like the best of the best. Now, yes, are there possibilities that people can make more money? For sure. But the key is consistency, and also to be able to come back from drawdowns that are not too large. And you could see here this second point, basically comparing that through to the S&P 500, which is essentially 500 of the largest cap stocks that are out there, and tracking that. And the compound annual growth rate there over the long term is roughly somewhere around 10%. Obviously, that varies depending on which period you look at. But over the long term, from about 1972 is where our kind of data can go back to. It's roughly about 10%. Now, Warren Buffett himself, if you then say, how much of a hit did he take? You can see that the hits were fairly large, and multiple hits here of 50% during various crashes, right? The global financial crash here of 2008, then the 2000.com bubble, COVID, then as well took about 25%, and recently now with the tariffs, we've seen a drawdown of about 26%. So the drawdowns are actually fairly in line with the S&P. So as a matter of fact, this is a chart here going back all the way through to 1972, and this is showing you the just get my pen here. This is showing you all of the drawdowns of the S&P 500 going all the way back through to 1972. But the key thing here to notice is that this is monthly data, okay? And this is important to look at as well, because when you're looking at something like this and you say, okay, that's fine. Well, it may not be fine because here you're taking like 45% drawdown, 45% drawdown, 51% drawdown, something like that. But this is on monthly data. And what happens is that for those of you that remember what happened during the COVID crash, and you look at this and you say, well, this is claiming a 20% drawdown, hopefully you'll know that that's not correct. Well, it is correct in terms of monthly data, but the reality is that on daily bars, this got all the way down through to 35 here. Okay, so this is one of the things you have to watch out for. As a matter of fact, I've got a video on my YouTube channel, which is a video that goes through not all of it, but many of the things that can kind of trick you with data analysis, things like this. And this is one of the ways that gurus can sometimes try and hide bad performance by simply sticking through to a higher time frame, because it hides the volatility in those lower time frames and you just don't get to see it, and they're not lying. Okay, but this would be a way for one of those gurus, for example, to be able to hide 35% drawdown and simply display it as a 20%, which looks far more reasonable simply by using monthly data instead of daily data. So, but going back through to the Warren Buffett scenarios here, you can see that these drawdowns are very much in line with what the market was doing, but he was able to basically double the performance compared through to what the S&P was doing throughout that entire period over there overall, which is impressive. So going back to that, if you are in a scenario where you can pull, by the way, let me do another quick little poll here. There's an index called HFRI. I forget exactly what the acronym actually stands for, but feel free to look it up, and you can track this on a monthly basis if you want to. And what it does is that it tracks the top 600 hedge funds out there, and they basically want to see how they're performing. And from that, they come up with an aggregate number of performance, and then we can aggregate that through to a compound annual growth rate. So let me ask you guys, what do you think is the average compound annual growth rate for the 600 hedge funds that they track? All right, type it in the chat, please. So I've mentioned that the market overall does around about 10%, the S&P 500 anyway, but they take significant hits, right? 50% hits, as we've seen multiple times. So what do you think hedge funds do?
We've got John saying 12%, Chris 6%, Stardust saying -5%, Henry 10%.
Yep. All right. So again, feel free to chase this up yourself, and it varies because it's like a sliding window, because I think they go back 10 years or something like that. But the average is about 4%. Okay, and you might say, what? How is that possible? If the market is doing 10%, but taking 50% drawdowns, how is it possible that the hedge funds that are probably just trading the market anyway, they're doing half that, if not less than half? Well, the answer for that is because in order to so-called spread risk, or to minimize risk, in the way that they present it, they machine gun investments all over the place. So in other words, they don't just put all the money into the S&P, because otherwise they're not going to be able to charge you a management fee for that, right? Like, you can do that yourself. So in order to try and justify their work, they'll say, oh, we'll create these, complex portfolios. We'll put a little bit of money here, a little bit of money there, and spread your risk out, and that'll be much safer. Yeah, it's much safer, but the problem is that the performance is much worse too. Okay, so the drawdowns are going to be less typically than what you see the S&P itself do, but you're then sacrificing performance because of that too. So that's the reason why that the majority of the hedge funds out there are basically doing an average of about 4%, which I think is a pretty big surprise to most people. So combining those two things, if you were to say, okay, if hedge funds on average are doing about 4%, and by the way, you also can't forget about inflation, right? If inflation is about 3% at the moment, 3 point something, and they're making 4%, you're actually on a net basis really just making 1%. So not much. And then there are management fees tied into that too. So you're not really getting anywhere in reality going with these institutions. So if you can get yourself to the point that you can be doing something close to around a 20% compound annual growth rate, not only are you just kicking the ass of all of these hedge funds, but you are on kind of par performance with one of the best investors and traders of all time, like Warren Buffett here. So 20% is, I think, a good target to aim for, and a fairly realistic thing that can be achieved after putting in the work to learn how to do all this stuff. But also be careful falling for the people kind of dangling carrots saying, oh, you can make 5% per month and 10% per month and all this kind of stuff. You might be able to do that for a few months, but you'll very likely blow out your account at some point quite soon after that, right? So here's a little kind of spreadsheet that I put together. I've got a link down the bottom if you want to just copy that and play with it yourself. But all you do here is you go through and you put in whatever starting amount you want, and then your compound annual growth rate, and then just does that simple calculation there. And then I've highlighted here what happens after 10 years and what happens after 20 years. So you can see that a $165,000 investment here, if you are getting a 20% compound annual growth rate, grows to $1 million over a 10-year period and grows to 6.3 million over 20. But note that this is on the assumption that you are not touching this money at all. And so what I'm getting back through to is that if you are being sold on this concept of, buy this guru course and within 2 months you can quit your day job and trade for a living, that's not this, okay? Because if you're trading for a living, you need to extract your normal money to live on, right? Your income from your trading profits. And guess what? You don't get any of this compounding because you're essentially pulling out everything that you're actually making. And on top of that, you cannot assume that every single year you're going to be making this 20% profit. Even Warren Buffett, as you saw, had multiple problem periods, right, of drawdowns of 50%, 25%, and so forth. So it's not going to be smooth sailing of zero drawdowns throughout that 10 to 20 year period. And what that implies is that if you are in a situation that you're so-called trading for a living, you need to pay your rent, you need to pay your food, you need to pay for your kids or whatever that might be. So the amount of stress that this is going to add on to you, even during drawdown periods, especially during drawdown periods, is pretty damn intense. So I know it's potentially a bit of a slap in the face if you had this dream of saying, oh, I want to quit my job and trade for a living. But just know that that is really fairly unrealistic. And what I would suggest is that you really try and focus on building wealth. And if you can get to the point that you've got yourself a nice buffer of so-called extra cash that you can rely on, not considered investment, just separate buffer, then maybe consider making the switch once you've got a very comfortable buffer that you can potentially live on. But the second that you start pulling from your investments is the second that you kind of kiss this dream goodbye in terms of the compounding effect that you can grow something like 165K through to $1 million just in 10 years. Right? But feel free to plug in whatever numbers you want there and see what that looks like there for you. One of the, I guess, major topics for this session for today is the distinction between discretionary trading versus fully mechanical trading. And yes, I'm being a little facetious here with calling discretionary trading like the gypsy looking into a crystal ball. But the reality is that there's a spectrum going between these two things, and a whole bunch of different factors that you've got to take into consideration. And by the way, I'm not one of these people that say it's my way or the highway. I have been across this entire spectrum myself, right from, like I said, I used to have 4 monitors, day trading constantly, trading every single type of style and system you can think of, through to the fully mechanical side on the other end as well, where it's a system that is 100% mechanical, and it is even executed mechanically as well. It doesn't require any intervention from me. So you'll see my evolution, and I'll fully express my, if you want to call it, bias, but that bias is coming from direct experience of having tested myself a lot of these things. And even still, though, I'm not going to say that, even though my preference, you'll see, slants more towards the fully mechanical side of things, I'm not suggesting that it's impossible to make money with discretionary trading. It's possible to make money in many, many different ways. but there are just pros and cons that you've got to be aware of, depending on what side of that spectrum you want to lean to. So the key thing is to understand what the factors are, and let's try and go through these one by one. So the first thing up here is the concept of learning. And learning is required for obviously either type of system, but the learning style is going to be very different. And what I mean by that is that I, for example, had gone through many times this kind of scenario where I would literally be studying under a guru for years. And that is not the amount of time that it will take me to go through their content, because that's quick. It takes time because, number one, the system is discretionary, and therefore there's no ability to even write down what the rules are, because it's more a matter of the guru saying, well, this setup feels right to me. And then you try and figure out, okay, well, I wonder what he's looking at. He might point through to a couple of things. He might say, well, we have to see, I don't know, let's say higher highs and higher lows. Okay. Is that enough? So in other words, if I tell you that defining a trend is defining a bullish trend is just higher highs, high lows. Okay, but what does that mean? What is a low? What is a high? You might say, well, it's obvious, isn't it? Like the high of a particular candle is a high and the low of a particular candle is low. Yeah, but that's not what you're looking at for a trend. You're actually looking for a pivot, right? So if you're seeing something like this, when you say, oh, clearly that's a high, that's a low, that's a high, that's low. Okay, but if you then look through closely, what if you then have, this kind of thing? Which one is it that you look at? Are you looking at this as an aggregate? Are you looking at a single bar? So as an example, you could do something like this. I call this a 3-bar pivot. So if this is a daily bar, in order for me to define a high, I could basically say I need 3 bars total in order to say that this is a local maximum here or a pivot high. For some traders, though, this is not enough. So what they might want is they may want 2 extra candles to the 2 candles to the left, 2 candles to the right. So this over here is now a 5-bar pivot. Other traders want even more confirmation. So this is what I'm getting at. You have to get down to the specifics of what it is. And a lot of the time when you're looking at discretionary traders, they don't even think of doing things like this, where you're going in through to as specific as possible so that you can communicate the plan in a clear, concise way that is repeatable as well. And that actually comes through to some of these other points that we're talking about. But the key is that from a learning perspective, since this side of the spectrum over here, by definition, is not specific, then that becomes a problem. But then even on top of that, you want to track performance. And since the discretionary side cannot feed itself into doing backtesting because they don't have specific trade plans, by definition, okay? This is no longer a possibility. Therefore, the only way that you can start tracking performance is to start tracking performance live. From the point that you find that guru through to the time that you decide that, it's a great system or it's a bad system. And that is literally years of time that you have to track that guru for in order to see if what they teach is reasonable. And that's a huge time sink, okay? In contrast, if you're on this side of the spectrum and you're talking about fully algorithmic trading, yes, there's definitely a whole bunch of stuff you've got to learn. You got to learn the basics of, potentially some simple form of coding if you get into the coding side. Maybe you get in through to statistical analysis and understanding how Monte Carlo works and, a bunch of other stuff as well. So yes, there's that learning that has to happen. Then there's the guru teaching a particular system, but now it's absolutely specific. So it's very easy to kind of, see what the trade plan is and then replicate that trade plan yourself. But the key is also that we can now take advantage of backtesting. And now we can backtest the past 10, 20, 30 years of data and actually see what that performance was without needing to have to track it live, because we've got specific data that we can backtest across every prior crash. And I can tell you that once you do learn this side over here, and then you go onto YouTube or whatever, and some guru says, oh, my system is doing this, this, and this, and you now have the ability to very simply go in and essentially code this thing up, in like 5 lines of code, or to put it into Composer as an example. And you then look at the performance, and the performance, 9 times out of 10 will be absolutely horrible. So it's a great way for you to find that needle in the haystack, if you like, in terms of a good performer versus the majority of the stuff that's out there that is just, mostly rubbish. They're just looking for YouTube views and traffic just to, promote the videos and make money from ads a lot of the time. So learning very different between these two. And again, I feel that this side over here is far more powerful for a number of reasons. I've touched on the concept of clarity of the trade plan. Having that clarity of a trade plan implies that the guru can now teach the student in a way that is 100% understandable, because it's just code, right? So you literally pass me the code for that particular algo. I can now trade that algo in exactly the same way that you would. And similarly, I can then pass it along through to a colleague or something like that. And there's no degradation, kind of like playing that telephone game, right, where one person whispers in the other. That doesn't happen because the rules are 100% specific. So clarity of the trade plan, I think, is a very important thing. Trade consistency, I've already explained that, and that feeds in through to backtesting. So all of these things kind of all combine, I think, quite nicely in through to one big package, and in my opinion, provide a lot of benefit through to the this side of the spectrum over here. Now, when we're talking about active monitoring, again, I've been in situations where I've had the 4 monitors that I'm looking at, and it would literally be stressful just to like go have a pee or something, like a toilet break kind of thing, because you are day trading there. Every little tick is something that you're watching, and you don't want to be in a scenario that, while you're away for 2 or 3 minutes, basically this thing crashes and it goes past your stop loss and all this kind of thing. So if you are trading from a discretionary perspective, you've got to have especially if you're day trading, you've got to have your eyeballs glued to the screen. That obviously is going to increase your stress levels, and it's quite intense, not to mention then that I remember even things like, taking holidays and that kind of thing used to be, extra stressful, because now I knew, how am I going to monitor the market now if I'm not, tied to a computer and so on. So it's definitely challenging. Now on the this side of the spectrum over here, in terms of fully mechanical, you can be in a position, especially with a tool like Composer, where not only is the analysis part automated in terms of the backtesting, but on top of that, the execution is automated as well. So you literally don't have to do anything. Now, that does not imply that you can go on a 3-month holiday to, Japan or whatever and never even look. I think it'd be kind of silly to do that. But you still want to monitor things, but there's no pressure, right? I mean, you can absolutely take multiple days off without even, looking at your portfolio, especially if it's one that's well bit. So I think that's a big benefit there, especially in terms of stress, which leads into this one over here, right? The difference between discretionary trading and mechanical trading from a stress perspective, I think is really quite different now. I'm not going to try and pitch you on the fact that you will have no stress when you're doing algorithmic trading, because that's rubbish too, okay? You'll have money on the line. You'll have potentially many algos that you're trading at the same time. So you do want to keep an eye on things. You do need to know, when do I pull out of a particular trade or algo versus when do I stay in? When is the drawdown normal versus when is it too much? You do still have to look at that. And during those periods that you are having a drawdown, your gut is not going to like the fact that you're down, 10K, 20K, whatever that might be. Those emotions will not go away, but they're much easier to deal with than if you're on the discretionary side. One of the reasons is because you're not trying to react to those emotions. And if you're on the discretionary side, you'll relate to what I'm saying here, right? Because when you're fearful, you'll tend to make huge mistakes. Even if you've got a trade plan, you'll be willing to break the trade plan. If you're at, if your price action takes out your stop loss level, you'll basically go, well, it's going to bounce back. It's going to bounce back. I know that the second that I close my trade, it's going to come back. So I'm just going to stay a little bit longer. Now you're at 2 times your max loss. Now you start to feel bad. And then you're like, okay, it's definitely going to bounce back now. Now you're at 3 times your max loss. And now you start to, worry about a whole bunch of other stuff. It is rough. Whereas with a mechanical system, if you said my stop loss is X, it gets out there and that's it. There's no questioning. There's no, I wonder if, there's no, I hope this or I hope that. And the other thing related to that is, and for people that have lived on this side here, you'll know exactly what I'm talking about here. And that is that when you do take a loss, and especially if it's a large loss, you now want a so-called revenge trade, right? You want to make back that money as quickly as possible. A lot of the time, I say this a little bit tongue in cheek, but with things like, I don't want to have to tell my wife that we've just lost $20,000, so I need to make back this $20,000 damn quick so that I can not have to have that uncomfortable conversation, right? Things like that absolutely affect you. And now you are making dumb decision after dumb decision because of the fact that you're being affected by your emotions. And your emotions are probably one of your greatest enemies when you're trading. So by being able to be on this side over here, it prevents you from making silly mistakes in terms of getting out, and it also prevents you from making silly mistakes potentially from getting in. Because if the criteria is not met for your trade entry, you are not going to be getting in. The system will wait for the right setup. It's not going to want to revenge trade at all. Okay, so those are really, I think, two big benefits of this in that particular spectrum there. Scalability. This is something else. So if you are in a scenario that you are, let's say, day trading, you have to be glued to that screen if you're day trading. And that you might say, okay, that you're happy to do that. Okay, great. But you might be day trading, say, the E-mini S&P or something like that, or oil or something, exciting, something that moves, or crypto, right? And you're glued to the screen, it's fun, it's adrenaline and all that kind of stuff. Okay, great. But you're trading one thing. And now if I tell you, I also want you to trade a different trade system or a different underlying, you might say, well, I can't do that. My eyes are glued over here. I got to focus. Well, okay, but you're focusing on just one thing, right? In contrast, when you adopt the mechanical side of things, you don't have that limitation whatsoever. So you can now be literally trading 50, 100 things at the same time, because it's not you that actually has to do it. It's a little robot that does it on your behalf. You're just like a top-level manager that is looking at things from a high level, but you're not actively the one doing the work. So your work is going to change from a management perspective now instead of from an execution. What I mean by that is that you'll be spending your time looking for new systems to add to your portfolio. So if you've already got, say, 20 of these little mini robots or algos working for you, you're now looking for something new to add and make it 21 and then 22 and 23. Okay? You're not having to spend your time looking at every single bar on the screen. So scalability is massively different between these two, right? Discretionary side simply does not scale. Okay? Over here, it absolutely does. And that is a huge benefit. Execution. With execution, if you are under the discretionary side, obviously you now have to do it. So that is the same thing that what I've just mentioned in the prior point. So you can either have robots doing stuff for you, or you can be doing it yourself. And these two things are obviously tied together. On top of that, you've got the ability to make mistakes if you're on this side over here. So you've got to deal with, again, like emotions can sometimes come into it too. So if the market is crashing, the bid-ask spreads are going to get very wide, and you're now not going to be as patient to get in because you got to get out, right? Because you're taking a $20,000 loss, and you don't want to take a $30,000 loss. So guess what? You're going to be happy to just close out that trade just quickly and not have the patience to do it in the way that you normally would as part of your trade plan, right? Just because the bid-ask spreads are super wide. Not to mention the fact that you could make a fat finger error. I've made plenty of these myself through the years. And you go, whoops, I accidentally did 10 contracts instead of one, or something like that. And without knowing it, now your loss is now 10x instead of 1x, okay? So that's not pretty. Last point here is tools and skills. So on the discretionary side, it's kind of simpler in a way, because it's really, the tool is your brain, if you like, and your fingers and mouse kind of thing to do it. You don't potentially need that much more. Whereas on the algorithmic side of things, you do need some tools, right? Because these robots need to run somewhere. So if you're using Composer, that's great. Composer is actually running the backend for you. But if you do get in through to wanting to run your own stuff, so as an example, you might have Composer doing 10 different algos, but maybe one or two of the algos that you want to run require more advanced functionality. Let's say something like machine learning or AI or something like that. So for that, you're going to have to set up your own infrastructure. So that now requires another set of skills and tools that you'll have to now leverage. That can be a little bit more complicated potentially in that aspect. But if you do stick with Composer for, let's say, normal style algorithmic trading, that part is actually very simple to do thanks to the Composer technology, right? So a whole bunch of topics there. Again, it's a spectrum. I'm not saying that discretionary is bad and algorithmic is good. I'm just saying that I've lived through all of these things myself through 20 to 30 years kind of thing, and I've gravitated through the years through to the algorithmic side for the various reasons that I've mentioned. So basically from this point, I think I will now start getting into trying to give you some tips about this side of the spectrum here, okay? And see if we can provide some specific takeaways. Now, one of the things with algorithmic trading is that you need to learn how to properly do robustness testing, because you'll have heard, I'm sure you've come across the concept of something being so-called overfit. So what does that mean? Typically, the understanding of something being overfit is that when you're looking at backtesting, the algo is doing something like this, and then the second that you start live trading, the algo does this. And everyone says, yes, that was clearly overfit. The problem is that you found out a little too late, and this is where you've lost money. So robustness testing is a series of things that you can do that try to filter out the stuff that is potentially overfit or the stuff that is just not good versus the minority of the stuff that is going to be decent, that pass all of your actual tests. So even though there's a lot to it, there's a couple of things that are fairly important. One of them here is a concept of in-sample versus out-of-sample. So what this implies is that you might have something like this, where this is your in-sample period, X number of years, and this is where you do all of your training. Okay, so you might say, let's pick something simple like, say, a moving average crossover. So you say, all right, what happens if I do a moving average crossover of, let's say, the 50 and the 200, simple moving average, and then you plot out the equity curve, and the equity curve looks something like this. You might say, okay, cool. What happens if I change it through to an 8-period exponential moving average crossing over a 34-period exponential moving average? And then you look at that equity curve, and that equity curve does something like that, and so on and so on. You keep running tests and then getting all of the lines over here. And then what is typically going to happen is that you'll then choose a subset of these and then say, okay, I want these top 3 best performing systems that have been trained during this in-sample over here. And then you're going to see what happens when you throw new data at it. So this is going to be the out of sample. And then if you then have systems that now do this, then you know that those are systems that are not good, and you'll literally be throwing those away. Now, if you have some systems that do this, then you might say, well, okay, cool, that's excellent. It's actually past the out-of-sample period, which is essentially new data, and the performance is relatively similar through to what I saw during the in-sample period. So that is something now that I'm willing to keep testing for in other ways in order to keep trying to see if it is robust. But that is the primary thing that I want to look at there. Now, the concept of market types. What's important when you're looking at this is you want to ideally, again, perfect world here, is you want to choose both an in-sample and an out-of-sample period that includes ideally every market condition that's possible within those individual periods. So what I mean there is that you want to see a crash event. You want to see a grind down. You want to see a grind up. You want to see a V bottom. You want to see a huge bull run. You want to see every type of market condition you can think of. Again, perfect world, okay? Inside of the in-sample where it's being trained, and ideally, all market conditions within the out-of-sample as well. I know that's tough, but I'm just explaining what an ideal scenario is. But the real world is not going to give you that, but you need to be careful with being too lenient here. I've seen many times where people do something like, let's say, a 3-year backtest, okay? and they say, look, the performance is fantastic. And then you have a look at what the 3 years that they were backtesting on were, and there were periods where the S&P was basically doing this, just going to the moon. Of course, every algo that you throw at it is going to do fantastically well. But the second that the market now starts coming down, you're going to get killed. Okay? So you got to be very careful to not be just optimizing or running a backtest across a single market condition. You want to have as many as possible in there, ideally all of them, but of course that's not going to be realistic. But just be very careful with choosing backtesting periods that are very bullish. And that's going to come back to bite you in the ass, really, really bad. Recency, this is the concept of basically saying, if an algo has done great over the last, say, 20 years on average, do you really want to be trading it if over the past 2 years it's been doing really bad? I know I don't. Okay, so that is the concept of basically recency. So most of the time, you could do something like this, where you say, this is in sample, this might be 60%. This is out of sample, here this might be, let's say, 30%. And then you've got recency, which might be 10%, something like that. Okay, so now you train here, you validate here, you then confirm that it's working currently here. And then at this point, you say, okay, yes, this passes. Ideally, I would also then here have what I call incubation. So I would then test this on live data, but with paper money, not with real money, for a couple months, right? Maybe say 3 months or something like that. And if it now, again, performs adequately across all of these periods over here, and this is what I mean by full time span, then at that point, I say, yep, I'm willing to now throw real money at this algo. Okay? Alternate time frame, what this is that let's pretend that you're trading a system that is on, let's say, a 1 hour time frame. Okay. Now, Composer is going to focus on daily or higher, but let's choose an example here because you'll see why. Basically, the example makes it easier to talk about with a 1 hour time frame. So, what an alternate time frame does is that it basically says, all right, if I've got an algo that works well at 1 hour, then if I choose another time frame over here that is relatively close to this original time frame, and I go down, and then I also go up, and I choose another time frame that's slightly bigger than this particular time frame, in theory, it should still perform adequately. It may lose performance, but I don't want to see something that is like this turn into something that's like that. Okay? I'm okay with, if it's like this, for it to then be like that, if it's on a slightly different time frame, but I still want positive performance. So the key is, how far out can you go? So if I'm trading on a daily time frame, is it okay for me to test on a weekly or a monthly? My suggestion is no. That's too far. Even from here to here, that's too far. Okay? So my recommendation to you is that if you're trading on a time frame of X, go down to half X and go up through to a max of 2 to 3X, no more. All right? So if you are trading a 1 hour time frame over here, go down to 30 minutes and go up to 2 hours. Beyond that, you're getting too far away. You're changing things too much. Okay? So that's what I recommend for that one. Then testing a correlated market. What this implies is that if you're trading a system built on SPY, as an example, then if you go and you replace this with a different ticker that is highly correlated to SPY, then in theory, again, you should see reasonable performance. Okay? And it's just another way to get slightly different candles that you're testing against. Another one that I've not listed here as an example, but it's because it requires more work, but more advanced coders can potentially do this, is that they'll take any kind of candlestick style chart, and they will then, via code, go in, and actually it's open, high, low, close, and they'll change the open, high, the low, and the close by, let's say, 10% randomly, between 0 and 10%, or between minus 10% to plus 10%, as an example, and now create slightly different candles, and then rerun that against your algo. And if your algo doesn't do well with just a slight 10% change, it's probably going to be a scenario that's going to be overfit. Another one is Monte Carlo. There's a whole bunch of really interesting stuff that you can do with Monte Carlo, but with many of you, you may not be quite familiar with what it is in a basic perspective. So let me explain that simply. Imagine that I take the daily returns of anything, let's say, SPY, as an example. And each one of these daily returns is represented here with a ping pong ball that's got that number in it. Okay. Now, from there, what I'm going to do is I'm going to start extracting one of those ping pong balls out after another, and then lining them up like this. And then from this, I'm then going to build out a cumulative equity curve that looks something like that. Okay, I'm simply adding these returns all together, and I do that for every single one of these ping pong balls, and that gives me one equity curve. Once I'm done with that, I grab all of my ping pong balls, put them back in the bowl, and then do it again. Take one at a time and build out an entire series, and now that is going to build out a second line. Then I put them all back in the bowl and go again and again and again. Okay, that is the concept of a Monte Carlo without replacement. And the key thing is that if we look at a Monte Carlo without replacement, it's going to start from the same point and they're going to end at exactly the same point. The path is not going to be the same, but the starting and end points are exactly the same. Now, in contrast to that, if we look at what is called Monte Carlo with replacement, what happens here is that I take out one of the ping pong balls and then I note that it's 0.9%, but then I grab this ping pong ball and I put it back into the bowl. Then I randomly choose another one. But notice that since I put the minus 0.9% back in, I could absolutely face a scenario that I could have now extracted the same 0.9% ping pong ball again. And then again. Okay, now obviously this equity curve is now going to look like this, and that's fine. But that's the key thing. So what we're doing is that we're looking at ping pong balls over here that define what normal looks like for this particular underlying or for an algo itself, because these could actually be trade returns as well. But the with replacement is going to give us spaghetti lines that start from the same place, but they do not end at the same place. Okay, it gives you a much wider distribution. And this is the one that I personally prefer to use instead of this one over here. So it's the Monte Carlo with replacement. And it's going to look something like this. Now, this line, the black line over here, is actually SPY over the last, actually it's from 2018 to 2023 in this particular example. Okay, not that it matters, but that's what it looks like. And then every single one of these other lines are exactly this concept of what I've mentioned, where we have all of those daily returns, and then we take one ping pong ball out, look at it, put it back in, and create the equity line. And you can see the distribution goes all the way from here, massive, massive profit, okay, through to a pretty sizable loss. Very wide distribution over here. So let's do another quick little quiz here. If I were in a scenario that my current run, so in other words, the thing that I was actually doing my analysis on was, let's say, this line here, which is one of the best performing ones there, all right? So let's say my black line was the red one up here. And this is what you saw when you ran the Monte Carlo. So your current run performs at the very top. Every other run that you've done here from randomized pulls of the ping pong balls, the lines are underneath. Okay. There are, if you literally go onto the internet right now, you're going to see people say typically two things, and sometimes it's split 50-50. Some people are going to say, this red line is a great result because our algo is beating all of the so-called randomized lines that are underneath it, so that implies it's a great algo. Roughly half the community will say that. Roughly the other half of the community is going to say that's actually a bad result to have the red line up on top because it implies that our algo is overfit. So tell me what you think. Is it A or B? Type it in the chat, please. Let me know which one of those which schools of thought you belong to there. Okay, good. I'm seeing a spread. I've got two people saying B, one person saying A. 3 saying B, 2 saying A, 3 saying A, 3 saying B. So I'm getting what I see on the internet, right? Which is about a 50-50 split. My answer to you here is, and if you start following me, you'll see that I love to do these kinds of things all the time. And it's actually a trap. It's actually neither one of these two. What do I mean by that? All right. When we're looking at this, This is us defining what normal looks like for this underlying. So in this example, for example, think of this as daily SPY returns. Okay, if I was to say, are these the types of returns that we're going to see with Bitcoin? The answer is hell no. It's going to look completely different. Okay, so these returns define what normal looks like for SPY. They are not fully random. Fully random is, I could say, 20% daily return and a 59% daily return. That's not what SPY looks like. That doesn't happen in one day. This is what normal looks like for SPY. So when we then construct equity curves, which is what we see here with Monte Carlo, all of these lines, therefore, are normal, to be expected. They're constructed from so-called normal returns. So by definition, they have to be normal equity curves. This is not what Bitcoin is going to look like. This is what SPY can potentially look like. The line that we have seen historically is this black line down here. But if it were this line over here, guess what? That is normal too. What it is, though, is that this is the luckiest line out of all of these. They're all normal. Some are lucky, some are unlucky, some are roughly in the middle. All right? This line down here is normal. It's just the unluckiest curve that we've seen, or the unluckiest potential that we could construct based on Monte Carlo. But it is normal. It is not abnormal. Okay? If we saw something like this, that would be abnormal. If we saw something like this, in terms of real trading, that would absolutely be abnormal. And this, by the way, is one of the ways that you can use Monte Carlo to figure out if you should be getting out of a particular trade or actually staying in. Because if it stays within the distribution of what Monte Carlo told you should be normal, that actually is fine, even if you're going down. Okay? But if you then go down more than what you saw in Monte Carlo, that can be a very nice way for you to say, you know what, I'm pulling out because Monte Carlo said it's not normal anymore. So therefore I'm out. Okay? So this B answer is closer to what I'm saying than the first one, but in my opinion, it's still not quite right. Okay? These are all normal. The line on the top is just the luckiest normal line. Does not mean overfit. Because, by the way, let me clarify that. Even though this over here is the luckiest line, when we start trading, we could now be on the black line, as an example. That's still a great return. It's given us positive returns at the terminal portfolio level. Okay? Does not imply that when we start live trading it, it's going to do this, which is what overfit kind of category would look like. All right, hopefully that's clear. Jason said C. All right, so here's an example of what an ugly looking graph looks like. Notice that there's a really wide distribution of lines at the terminal portfolio over here. When we get there, there's plenty of lines over here still under zero. It's not a tight distribution. Okay, it's just, ugly. Like when you see a Monte Carlo like that, you go, no thanks, don't want to trade that algo, right? Whereas when I look at something like this, that looks much nicer now, right? Bottom left to top right, a much tighter distribution over here. Notice that the number of lines that are underneath zero disappear. So in other words, every algo that would, every run of this particular strategy, after about roughly, what is that, maybe a quarter of the timeline over there, is now above zero. And that's what I want to see. Normally, I'm willing to give it up to about a third of the backtest period. I want to see all lines above zero after about a third in general, okay? But that looks like a much nicer distribution there. So, trying to be mindful of time too. But anyway, let me quickly touch on a couple of sizing for individual strategies, right? So you've got fixed lot size over here, which is the concept of you saying, I'm going to trade 100 shares. That is actually not a particularly good way to do that, because what will happen is that when you're backtesting through many years, that underlying can double or triple in price, or more sometimes. So now when you're trading 100 shares and it's now triple the price than it was at the start of the backtest, now you're taking on 3 times as much risk as you were at the start of the backtest. So you're not keeping your risk equivalent throughout the backtesting period, and therefore it's not a particularly good way to go about it. Fixed dollar size for your trades is better because now you are going to have equal risk for every single trade that you're actually going to do. But one of the limitations here is that since you're risking always, let's say, $10,000 per trade that you risk, then if you're now making money and your account is growing in size, you're not taking advantage of that fact. So you're not essentially compounding your trade size. You're just keeping it fixed, and therefore the extra profits are just going to be sitting there, not doing anything that may not be realistic for your test. Kelly criterion is something else that you'll see a lot of people talk about on the internet. It is okay to use Kelly criterion, but it is wildly overstated if you just use the actual Kelly number, the raw one that comes back. It's going to be way too aggressive, and I've got some slides that we can look at for that. Account drawdown is one I actually like to do as well, and that is if you then say, I am comfortable, even though you're not going to like it, but you're willing to tolerate, let's say, 20% drawdown in your actual account, then the simple thing that you can do there is to basically keep that in mind for each particular trade. So as an example, if you say, I'm going to be placing $1,000 trade here, if you then want to know what should my account size be, if I want my max loss to be 20% of my account, all you do is you basically just divide 2,000 by 0.2, and then that is going to tell you the account size that you need to have. So I quite like that one there. So this one here is how the Kelly criterion is constructed, but you know what? I think I'm going to actually skip through this, being mindful of time. Just know that this is, again, Kelly criterion is really very aggressive. You typically want to do something like 10 or 20% of what the Kelly number comes up with. This one I do want to touch on though, because this is something I do myself and something I recommend. This is another way to use Monte Carlo, not just to determine if, looking at the spaghetti lines and saying, does it look good or bad, but then being able to doing that Monte Carlo analysis on the drawdowns, okay? Because when you look at something like SPY and you say, yes, SPY has, gone down, say, 45% or 50% since it's been trading, that is that one run that we've seen, the one that has been so-called live, okay? But if you then do 1,000 runs of those sample returns so that you're looking at so-called normal data, okay, and not just completely randomized data. So we're looking at 1,000 runs over here, and then we look at the drawdowns of those 1,000 runs. And now what you can do with Monte Carlo is that you can see a histogram over here of, when you see 40 here, this is the percent drawdown for X amounts of those spaghetti lines, but now for the drawdown perspective. And this over here, the y-axis is now how often has that happened in terms of frequency. So you can get that, and then you can do this analysis over here, which basically says, what kind of confidence level do you want? And here I'm saying, if I was to want to be 90% confident that the drawdown, so 90% confidence of what the drawdown was over 1,000 runs is what this thing here implies. And what this number now tells you is that over 1,000 runs, there's 90% confidence that the max drawdown will be 61%. Not 45%, 61%. Okay, so this is a much nicer, or in my opinion, a much more statistically meaningful way for you to define what your drawdown is. And this is a simpler way for you to say what is the pullout point for my strategy. So if you were trading SPY and SPY were to draw down 50%, well, that's happened multiple times, so you know that that's literally normal, so you would stay in. If it goes down 55%, you'd stay in because that's also been seen. But if it goes beyond 61%, Monte Carlo is now telling you, what, that's too much, right? You really should pull out. So this is a simple way for you to know what the pull-out point is for your strategy. Now, obviously, your strategy, for me, 61% is not reasonable at all. I would dismiss this. And this is why I don't put all my money into SPY, right? The drawdowns are just too large. It's not something I'm willing to tolerate. I'm much more of a conservative trader, right? And I found through teaching many traders myself that most traders have kind of like a point. Once you go beyond 20% drawdown, that's a point that people have trouble sleeping and all that kind of thing. So I think is a good target to try to stick to in terms of what your drawdown for your entire portfolio is going to be. But again, very, very useful to use Monte Carlo for drawdowns, right? So that you know when you can actually pull out. Now, I'll probably make this, and we'll come to a conclusion very, very quickly. Again, I want to be mindful of time, but this is a really important point that I want to make here. So another quick little test here for everybody, okay, to interact. Strategy 1 that I'm going to do has a compound annual growth rate of 15% and a max drawdown of 30%. Strategy 2 has a 10% compound annual growth rate with a max drawdown of 20%. Okay, now I'm going to take my money and I'm going to split it 50-50 across these two strategies. All right, half my money into the top one, half my money into strategy 2. What is going to be my combined portfolio level compound annual growth rate and max drawdown? Type it in the chat, please. Okay, interesting. Getting a couple of mixed things. Some people coming up with some specifics of what the numbers are. Some saying it depends. Some of you are actually on the right track, which is good to see. Okay, here's the answer. The answer actually is not just it depends. By the way, it's not just purely a trick question. For CAGR, it's what you would expect, right? So if I do 50-50 across these two, my CAGR will be 12.5% in my backtest if I rerun that backtest doing 50-50 split. Okay. The thing is, most people assume that this applies over here as well, and they would say this should be just the average of the two. Okay, and this is where the magic happens. All right, and so even though we get what we expect over here, this does not happen. And what we can actually see is we can see a scenario where our drawdown might be something like 15%, which is less than either one of the individual strategies. Why is that? Well, because if I'm looking at a period of time where strategy 1 is in a drawdown over here, if I have uncorrelated returns with multiple other strategies, I'll have some other strategies, hopefully, that are doing this during the same period of time. Therefore, on a net basis, it might just even out, and I have no drawdown. Okay? So the key is to be able to build a portfolio that has uncorrelated strategies and uncorrelated returns combined together. Ray Dalio himself calls that concept the holy grail of trading. It is massively important to be able to do this. And now when you're saying, okay, but how can I determine that? Well, this thing over here, this is called a correlation matrix. And this is a fantastic way to look at combining strategies together. So as an example over here, I've got strategy 1. And then what this thing shows you, for example, is that if you trade strategy 1 against strategy 2, they have here a 19% correlation between the two. Right? Strategy 1 versus strategy 3 has a 68% correlation, and so on and so on. So when you're looking at this, the ballpark figure that I'll give you there is that ideally you want to stick through to 0.6% or less for correlation. Okay? If you are in a scenario like this on the right, where I had a trade over here say, look, I'm trading these 7 strategies, and the first thing I did was to basically run the correlation matrix, and then I saw 79%, 83%, 82%, 84%, 90%. Okay? The second that I saw this, my first response to the trader was to basically say, look, the correlation is so high that you could literally just pick any one of these and just put all your money in that, and you'll basically have roughly the same performance. So you have no benefit to splitting out across 7 strategies when the correlations are this high. It's like you're just trading the same thing. Just one's got a pink jacket on, one's got a blue jacket on, but they're the same strategy underneath. Okay? So this is a very, very simple way for you to determine, when you want to add an additional strategy to your overall portfolio, to determine whether it's worth it for you. Okay, depending on what else you're actually trading in your basket. A whole variety of different ways that you can size here for when you're now combining things into a portfolio. Okay, which unfortunately it looks like we don't have time to get into there. And then examples of the types of things, because remember, when you are an algorithmic trader, you're not spending your time with your eyeballs glued to the screen. What you are spending your time doing is researching other edges that are out there for uncorrelated strategies and uncorrelated returns that you can add to your overall portfolio. Okay, so here I've just listed out a whole bunch of stuff that you can potentially look at. So everything from different types of underlyings and markets, ETFs, or to mixing up between large cap and small cap. Bonds have different maturities. You could even diversify across that. Developed international versus emerging markets as well. Commodities, this is a really good one to diversify, right? Because even if the market's crashing, everybody still needs to buy, meat and orange juice and whatever. So you can trade those things and completely uncorrelated through the market most of the time. Crypto, funnily enough, used to be uncorrelated, be correlated more to gold, but now these days is highly correlated to the market. But you can get diversification in terms of the fact that it's very volatile, and if you've got strategies that can take advantage of that, that's something that you could do. Trading futures, a whole bunch of interesting ways to do that. Trading options, a whole pile of different ways to make money from trading options. And then different types of edges that you can look at, right? So everything from momentum and trend following, value, which basically means buy the cheap stuff, growth, buy the stuff that has good fundamentals and is growing very well, breakout trading versus reversion. Reversion is like buy the dip. Breakout is what it sounds like, right? Breakout. Seasonality plays where, especially with things like commodities, they have very clear seasonal patterns that you can take advantage of there. But it also could be something like trading the turn of the month effect or something like that. Earnings, news events, sentiment, machine learning and AI, intermarket relationships. This is kind of like saying where you monitor one type of market, but then you make an investment in a different type of market. Okay, so if the dollar goes up or down, then that leads you through to make a trade in gold, as an example. Trading volatility, a lot of ways of doing this, especially if you then hook that up with trading options as well. Factor analysis, this is the concept of where there may be no theoretical edge in a particular type of trade, such as, let's say, earnings is a decent one, okay? So recently did an analysis where we saw that if you were to trade every single earnings event with an option structure called a straddle, there was literally no edge whatsoever. The average gain was like 0 across thousands and thousands of actual trades. But if you then go in and do factor analysis and then say, okay, what if I trade when the term structure is something called, backwardated. I won't get into what that is, but, saying if factor 1, factor 2, and factor 3 match up, then we can be in a scenario that something that had no edge now actually does have edge. And then these things over here now transformed to having an average trade profit of about 8%, right? By looking at the factors. And last one here is pairs trading. Pairs trading is the concept of you trade one thing against the other. So the typical one everyone talks about is Coke and Pepsi. So what you do is that if Coke itself becomes overvalued, you now short Coke and you go long Pepsi, and vice versa. Okay. The nice thing about that is that if the entire market crashes, you're not losing money in that particular scenario with a pair, because all you care about is just the difference between Coke and Pepsi. So that's an interesting one to add to a portfolio when you're looking at adding diversified, uncorrelated returns to your portfolio. Okay. And last one here is just the concept of tools. I know that was one of the questions that came up. Obviously, for Composer, you can use that for, it's a way of doing no-code backtesting. If you're looking, though, to get into algorithmic trading, you've got what I call simple versus advanced. There are some very simple languages, if you want to call it that, that you can learn very quickly. But TradingView is one that have a language called PineScript, pretty simple to learn. TradeStation has a language called Easy Language, right? As the name implies, it's very easy to learn. Amy Broker has something called AFL, Amy Broker Formula Language. The thing to know is that TradeStation is good for creating algos on a specific ticker. So if you want a system for trading SPY, TradeStation is a great way to do that. As an example, Amy Broker specializes, you can do that as well, but the key thing is that it's much better at doing portfolio level trades where you say, for example, let's start with an entire universe of maybe it's the entire S&P 500. Out of that, then let's rank that, let's just say, by a criteria such as momentum, and you now say, let's pick the top three that are performing the best out of that particular basket, and then apply all my other criteria that I want. So RSI has to be above this level. I got to see this candlestick, blah blah blah, to actually trade. So Amy Broker is much better at doing that, where you're looking at an entire universe of tickers, applying a filtering criteria, selecting a subset with multiple tickers, and then trading systems across that. Okay, that's something TradeStation cannot do. So these are all very good, all three of them. And then if you want to get really advanced and do machine learning, AI, and all that kind of stuff, then you're typically going to gravitate through to Python, and R is another popular language there. Now, if you're doing options, simple but good options backtester there is from a company called Option Omega. But then if you want to have more complex rules of saying this has to line up and this has to happen and all of this, more complex criteria, you're basically going to be looking at more advanced tools. Trade Tracker is one that is available only within our Trading Dominion community, but MesoSim is a product that you can subscribe to from a company called Delta Ray. And OptiTrade is a product from a company called Charm Traders that you can look at. They're both very good. So that's backtesting. Then for execution, if you want to automate that, a Composer, obviously, very simple, and you can't get more straightforward than that. So great one to look into. For simple code, TradingView, TradeStation, Amy Broker, these are the same ones that we talked about before. You can use those same platforms to do the execution as well, which is nice. You could, of course, do that with Python and R, but you now need to build your own infrastructure there, so that's quite a bit more complicated. And then if you want execution automation for options, you can look at a company called Option Alpha, Trade Steward, or Trade Automation Toolbox. Those are probably the top three that I see mostly. Yeah, I'm going to skip through leveraging AI. I had some tips on how you can leverage AI for Composer, but we're obviously already quite a bit into it, so I think I shall leave it there. I guess the very final thing here is if you guys wanted to explore more stuff from my side, you could go to tradingdominion.com. And then from there, these are the main three courses that I currently have available. This is the course that I think everybody should really start off with. It's called Portfolio Investing. And if I just scroll down, you could read through all that yourself. But if I scroll down to the bottom, it's going to show you the structure of the course. So you can see here everything from understanding how returns are properly calculated, multiple ways of measuring risk, factor models, permanent portfolios. Permanent portfolios are things where you say, I'm going to invest in these particular tickers at this particular weighting and so on. Whereas then you have, let's call it dynamic portfolios, where you're rebalancing that portfolio every month, as an example. And obviously with Composer, you can rebalance every day as well. Modern portfolio theory, momentum style stuff, multiple portfolios that are shown, sample portfolios that you can actually start trading. And then in the forums, we have a whole pile, dozens and dozens of different viable portfolio types that you can trade based on community input. And this is all from our private community, right? This is not open through to the public, but you will get access to it if you go through that particular course. So that's, if you want to explore more stuff with me, that's, I think, a good next step. And I think I'll leave it there because, again, I want to be mindful of your time, even though I wanted to keep adding more value there, but I want to be respectful of everyone's time commitment. So I'll come back to you there, Michael, or if we have any more questions or anything like that you want to cover.
No, that's really great. Ron, again, thank you so much for joining us and sharing all this expertise. It's been incredibly insightful. And I think, I know we were kind of out of time and there's some things that you didn't have a chance to get to. So, if you definitely want to learn more from Ron's work, definitely check out Trading Dominion. And Ron, feel free to drop a link, I guess your website or your contact in the chat as well. I'll also just add a plug for Composer. If you're exploring automation, a Composer is built for traders who want, the structure and also now the flexibility With our no-code platform, you can run repeatable rule-based strategies while keeping some manual control and active monitoring when it matters. We just launched Run Now, Buy Now, and Sell Now, so you can run your strategies, invest in them at any time during market hours. Thanks again, everybody, for joining us. And Ron, I'm not sure if you had any last statements that you want to share,
No, I'm good.
or
Yeah. Hopefully
okay.
everybody,
Otherwise,
got some tips that they can walk away from. That was my main objective that I really wanted to hit.
awesome, awesome. Okay, great. Thanks everybody for joining us, and we hope to see you at the next webinar. See you guys.
Thanks again.